In the last couple of days, the stock market has dropped a lot. That has made up for some big buying opportunities at the moment, but unfortunately most of the stocks that has fallen quite a bit is in the software space. But now let's have a look at how you should structure your investment portfolio, because you shouldn't just own a lot of growth stocks, because when they're falling, or a lot of software stocks, because when the share price are declining, then your portfolio is fucked. So today I'm going to have a look at how you should structure your portfolio, and I have about 5 stocks for you, and I got one extra stock that I think is worth looking at the moment. And thank you guys so much for the support on the Fubo stock I made 5 days ago or 6 days ago now. The only thing I need from you today is you leave a like, and if you want, you subscribe. Good. So why these 5 stocks I've selected? Because we got some growth stocks. Growth is great, but they're not stable, so returns are very fragile. If they perform well, the returns on this share price is insane, but if the quarterly reports is not great and they showing decline in the business, then the returns become fragile, right? This is also to have a look at to be more diversified in your portfolio, so you just don't own a lot of growth stocks or a lot of dividend stocks. Because if your entire portfolio is dividend stocks, then you won't get as highest return on the share price. But if it's only growth stocks, then you won't get any dividends, and we want dividends. To be diversified lessens the risk. It's too risky to have all your eggs in one basket, right? So too much growth is fast growth, fast decline. Too much dividends is slow growth, slow decline. And too much stable stocks is mid growth and mid decline, right? So the perfect thing is to basically have a lot of everything, if that makes sense. To own some dividend stocks, to own some growth stocks, to own some stable stocks, so you can sleep at night. Very important. The ideal portfolio I've set up here is 40% in growth stocks, 20% in dividend stocks, and 40% in stable stocks. And that's because stable stocks basically just follows the market, maybe outperforms the market by a percentage or two. We got the growth stocks, which either insanely outperforms the market or they are way behind. Then we got dividend stocks. So why this setup? Because when things are looking good in the market, the returns on the growth stocks will basically be the runner for the portfolio, right? But if the market is going like sideways and stuff, maybe not so good, the growth stocks won't see as much of return. Then we got the stable stocks. Stable stocks will always just basically follow the market. But what if there comes a decline in the stock market and share prices are insanely cheap? Then you got the dividend stocks. Dividend stocks won't follow as quickly. They will not just drop 30-40% in a month or 3 month span. No, they will pay you out dividends. And what can you do with this dividend? You can reinvest into the growth stocks. So you can buy more growth stocks when the prices are low. And this is the ideal portfolio I set up for myself, but I'm also 20 years old, so this won't work for a 40-year-old or 60-year-old, right? So the first stock we're going to look at for the growth segment is the Fubo TV stock. I've just talked about this 1 week ago, and they have come out with a report since. I've not yet read it, unfortunately, but I can see they have dropped quite a bit, 30% of something. As you can see here, the last 5 days, they have dropped 31% from about $2.30 to now down to $1.62. I will cover this in a video a couple of days from now. So what is Fubo TV? Fubo TV is a live TV streaming platform primarily focused on sports, offering subscribers access to live sports, news and entertainment channels over the internet without a traditional cable subscription, like Comcast and stuff like that. Its business model is mainly subscription based, with the user paying monthly fees for different channel packages, while the company also generates revenue from advertising. Fubo TV differentiates itself through sports-centric features like live stats, multi-view streaming, and interactive betting-related integrations. Fubo TV is basically just a streaming platform primarily focused on sports. So the valuation, let's have a look at it. The share price at the moment is $1.62. which gives this market cap of $2 billion. The PE is at 9.53 and the earnings per share is of 17 cents at the moment. Why do I think this stock is great at the moment? Basically, they got Hulu TV integrated into them. So it's not just Fubo TV, it's also Hulu TV. They are backed by Disney. Disney owns 70% of the shares in Fubo TV now. And still the stock fell like 31% after reporting earnings. I have 3 good things why Fubo TV is a great stock to buy. Disney backing changes the entire risk profile. It's no longer a small, fragile, standalone streaming service. The balance sheet's looking better after the Disney acquisition. Then we got the massive scale jump with Hulu Live TV. So before, Fubo had like 1.6 million subscribers, and with Hulu Live TV's 4 million subscribers, they are right now at around plus minus 6 million subscribers, which improves the negotiation power when you're negotiating for the streaming rights deals. Give them a lot of advertising potential, right? And this should also increase the margins over time that they integrated Hulu Live TV. And then I wrote clear catalyst driven setup. So this is because at the moment the share price is very low. It's not looking good for Fubo right now, okay? But if the execution improves on Fubo TV, so they will make a little bit of more money or get some more subscribers or basically become very profitable instead of just 17 cents. I know this is still quite a lot. I mean, the PE is looking at 9.53, but still, then we could see this stock skyrocket. I mean, like a PE for a streaming service company of 9.53, that's nothing. I mean, the PE of Netflix at the moment is 25.65, and they have also, like, their stock is down like 40% the last year since all-time highs in 2025, the summer. We got Warner Bros. Discovery trading at a PE of 69. That has probably something to do with the potential acquisition. But still, Fubo TV should not be trading around a PE of 9.53. So what are the bad things about Fubo TV? What are some things you should consider before buying this? Streaming is still expensive. The streaming rights to sports is still very expensive. And the profitability of these brand deals, or not brand deals, these sporting rights, they're not guaranteed to make Fubo TV a lot of money. Or even some money. But the bigger they become, Fubo TV, the more subscribers they have, the bigger the company they become, the more revenue, the bigger the chances for them to be very profitable. So number 2 is execution and integration risk. This is because they are right now merging a lot of platforms. They're merging Hulu Live TV, they got Fubo TV, they have to merge the employees of Hulu Live TV and Fubo TV. If the execution of Hulu Live TV integration is not going great, then the investment case is not that great. But we'll have to see. It's a high risk, high reward kind of stock, right? Plus, it's a very highly competitive market. Like, you got Peacock, you got Warner Bros., you got Discovery, you got Netflix, you got Prime Video, you got a whole lot. So it's very, very competitive niche. The next stock is, of course, Honest stock. And this I've also put in the growth. So Honest company, if you don't know it, is a consumer goods business focused on clean, sustainable products for families, including baby care, personal care, and household essentials. Its business model centers on selling branded products directly to consumers and through major retail partners. The company differentiates itself by emphasizing transparency, ethically sourced ingredients, and environmentally friendly practices. So Honest company basically is a consumer good brand which is primarily focused on baby products, and it's got a strong brand. I mean, if you watch my latest video, you will see a more deep dive into the Honest stock, but it's a very good company. At the valuation at the moment is about share price $2.36. We got the market cap of only 264 million. Nothing. The PE of 30 and the earnings per share of 8. 8 cents. So you're probably wondering, why would I buy this growth stock if the PE is at 29.32 and it's only a market cap of 264 million? Because things are turning around for Honest stock. Things are turning around. They are becoming more profitable. They are transforming basically right now the entire company to either grow a lot faster and make a lot of money, or be bought out by a big company like Kroger or Unilever. And you can see here the last year, the Honest Company's stock price is down from about $6 to right now $2.36. Absolutely bad, very, very bad. They're down 62%. So what is the good things about investing in Honest Company? So they are a strong, trusted consumer brand. Honest has built a really trusted fan base. The consumers trust Honest, especially in the baby products and personal care. And they basically do that because Honest is so transparent about what they use in their products, and is very sustainable. And that support basically repeats the purchases from consumers. So if the consumers trust Honest and they like the products, they will buy more. And this gives Honest a pricing power over a longer term, but still, if they trust the brand, they will buy it again, right? So clear turnaround toward profitability. Honest Company has had a bit of a problem with being profitable, but now things are looking good for Honest. The company has shifted focus from growth to profitability. And that's also why if you look up the Honest Company Transform 2.0 or Transformation 2.0, they are cutting off like the division of the Honest Company, which doesn't make a lot of money with low margins. Fuck that. Let's focus on the stuff that makes a lot of money. And then I wrote asymmetric risk reward setup. And what the fuck does he mean about that? It's because Honest Company, you can see the stock price was down 63%. They have had a lot of years where they have underperformed. Honest stock has had a high expectation and they've underperformed. So the stock price have been like a rocket ship and then like a submarine. It's been all the way to the moon and then it's been back down at the ocean again. And now, right now, we are at the ocean, or we are at the bottom of the ocean, hopefully. So at the moment, the expectations for Honest it's really low, to be honest with you. So the risk reward setup here is if Honest Company can perform on these expectations and they can outperform them, you will see the stock price increase quite a bit, because then the expectations will come back, and if they keep outperforming the expectations, then we will see Honest Company coming up from the bottom of the ocean and probably going all the way to the moon. So the bad things you should consider before investing in Honest Company is the highly competitive consumer goods market. You got a lot of big companies in this baby care and personal care. They are competing with a lot of big companies which have a lot of money for marketing, and they got pricing power basically. But Honest Company is sustainable and they are very transparent about it, so I believe this will not be a problem. But this could also be a good thing, because then maybe they could be bought out at, like, let's say 2 billion. That's an 8x of your investment. That's absolutely phenomenal. We got the execution risk in turnaround. So right now it's Honest Company is turning around. Like, that's also why the earnings per share is also at 8 cents. If this execution fails, then we will see the stock price keep on falling. Then we have not hit the bottom of the ocean yet. And then I wrote limited growth narrative. And this is because they right now doesn't focus a lot on growth. They are focused on becoming profitable. So for this company to basically turn around a lot, they're not focusing. They don't have like this high growth in revenue, like the revenue is growing like 40% year over year. That's not going to happen with Honest. But we could see that the gross profit margin is growing 40% year over year. They may rely on this margins becoming better than the revenue growing. Okay, next company. Now we are in the staple stock. We got United Health, UNH. And some people may like this, some people may not, but it is what it is. So Company, the United Health Group is a diversified healthcare company operating through two main segments: United Healthcare, which provides healthcare insurance, and Optum, which delivers healthcare and services, data analytics, and pharmacy benefit management. Its business model combines insurance premiums with service-based revenue from care delivery and health technology. By integrating insurance, care, and data, the company aims to lower costs while improving healthcare outcomes at scale. Blah, 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 blah. So basically, United Health Group it's two things. It's an insurance company and it's a healthcare company. The valuation at the moment is sitting at $275.92. The market cap is $250 billion. But for so big of a company, the PE is only 15.45 at the moment. What? And the earnings per share of about $18. So if you have a look at this, the last year, let's have a look. In the 10th of April last year, the stock was trading about $600. $600. And the 52-week high is $606. And right now, they are down to $276. If you look at last month, they're down 18%. 18. They had a drop here on the 26th of January from $352 all the way down to $289, and they've keep on declining. What are the good things about United Health? So because that big of a company shouldn't be able to decline the share price at that much. And Johan, why did you put it in stable? It's because it's a healthcare giant, okay? It's big. It's the biggest healthcare company in the US. United Health is the biggest health insurer in the US, and healthcare, as you know, is non-cyclical. It doesn't matter if we are in a recession or if we are in the biggest boom market of all time. Everybody needs healthcare insurance, or they think so. Everybody has to pay it. So United Health, the revenue it keeps on coming. It doesn't matter if there's a recession. Probably not a recession, but it doesn't matter if a lot of people lose their jobs and stuff like that. Everybody has to pay for healthcare. So Optum diversification is a major strength. What was Optum? Optum was the healthcare service, data analytics, and pharmacy benefit management. This Optum, if you have a look at the quarterly reports from United Health, you will see that Optum is a higher margin growth, and this also provides United Health from not relying on the insurance. They still do at the moment, but in the future they will not rely on the insurance from people, the insurance profit. They will also have Optum, which is great. Plus, United Health, strong cash flow and shareholder returns. They generate an insane amount of free cash flow. And if you don't know why free cash flow is important, it's because this is what they do to pay out in dividends. They are buying back shares. They have to reinvest into the company. So it's really important for United Health. And the bad things about, or things you should consider before buying United Health, is regulatory and political risk. Why? Healthcare is a very highly regulated sector, and changes in the government policy or reimbursement rules, they can directly impact the profitability of United Health. Slower growth compared to tech. It's United Health is a mature company, so they won't have explosive growth. The returns are more stable. They will not decline, but they won't grow that much. It's very stable. Then cost pressure from medical expenses. Rising healthcare or unexpected costs, they can temporarily compress the margins. They can make the margins lower. So that's something to look out for. So the next stable stock we got is Visa, ticker V. And you all basically know what Visa is, but I'm just going to tell you. It's a global payment technology company that operates a network enabling electronic payments between the consumers, merchants, financial institutions, and governments. Its business model is transaction-based, and this is very important. It's transaction-based, earning fees from payment volume, data processing, and value-added services, rather than taking credit risk. By providing secure and reliable payment infrastructure, Visa benefits from global consumer spending and the continuous shift from cash to digital payments. Very nice. Okay, why? Because Visa, they own the data processing. They want you guys to buy with the Visa card, but that's really not what makes them a lot of money. It's the system they built up. Okay, valuation right now, the share price it is at $330 a share. This gives them a market cap of $629 billion. But at the moment they only have a PE of 26 and a earnings per share of about $12.85. If you have a look at this, the last year Visa stock is down about $4.40. They are down roughly 20% from the 52-week high. But the very important thing about Visa is they are growing. You can see it in the last 5 years, 57%. They are growing, but the dividends is also growing. The dividends is quite impressive. Yield 0.8, doesn't really matter. But the 5-year growth rate is 15%. I know this isn't the dividend stock, but keep in mind they also pay dividends. So the good thing about Visa is they got an extremely strong business model. They don't take the credit risks. They earn fees on the transactions that's been made. They benefit basically from every transaction made on the Visa network, right? Okay, number 2, digital payments. So more and more people are shifting from cash to digital payments. I mean, every year more transaction comes onto the Visa, and it's because maybe in the emerging markets they still use cash. They will get Visa, and more businesses will allow Visa to pay, and then you can pay them, and the transaction basically increases, the volume increases. But the very nice thing about Visa is they got high margins and impressive free cash flow. So they are making a lot of share buybacks. They are very focused on the long-term shareholder value. So they are buying back shares, they're paying dividends, they're still growing the business. It's really a very good company. I will make probably a video in the future about Visa because it's a very nice company. The things you should consider before. I don't think this is that important, but it's things to consider. They are a dominant payment network. Them and MasterCard is basically the top notch. There could be some risk involving or regarding the regulations, right? Because they are huge. It's a huge company. Their profit margins is insane. So if there comes some regulation about the profit margin of Visa should only be 20% because they should not make money on the customers, then I don't know. But there's a risk. They got exposure to economic slowdowns. So if there comes a recession or if there comes a slowdown, this will impact Visa, not a lot, but it will do. And that's because they make a fee on every time there's been made a payment with the Visa, on the Visa system network. If people are buying less or using their credit card less, then a Visa company will make less money. And the last but not least, a limited upside surprise. And that's because Visa is at a $629 billion market cap. It's very high quality though, but it will not deliver a 40% increase in revenue or 100% increase in profit margins. It will not, and I don't think it will ever do because it's a very big company, it's a mature company, so that won't happen, right? Okay, the next stock and the last stock on this list, and you remember that now we've covered the 40% growth stocks, we've covered the 40% in stable stocks. Now we got the interesting one. We got the dividend stocks right here. And this is a stock I've chosen myself again. Altria Group, ticker symbol MO. So Altria Group is a consumer staples company primarily focused on the US tobacco market, best known for its cigarettes and smoke-free product brands. Its business model is built on selling regulated tobacco products while generating strong cash flows, which we like to hear, through pricing power and brand loyalty. Altria also invests in reduced risk products and strategic equity stakes to adapt to changing consumer preference and long-term industry trends. So that was a lot of words, but basically Altria, they are a company which are focused on the US tobacco market. They got brands like Marlboro, which generates an insane amount of cash. What will they do with this cash? They buy back shares. They pay it out in dividends because they got an insane dividend yield and dividend growth as well. And they also invest in the future. I mean, they had a big of a flop in 2016 or 2015 where they invested a lot of money into Juul, the e-cigarette company. And they lost a lot of money on that. But they are investing a lot of money into reduced risk products, which is very nice for the future where Marlboro and cigarettes and tobacco may not be here. They're also investing into that. But for now, they are using the strong cash flow to generate a lot of money. Valuation is right now at $65.16, the share price, which gives them a market cap of $109 billion. The PE is only at $11.66, and that's because this is not high growth. It's very stable, it's very slow, not that interesting. And the earnings per share is $5.59. If we have a look at this, the last year, Altria Group is up 24%. Last 5 years, 53%. Not a lot of growth, but it's still alright. Earnings per year, 59, blah, blah, blah. Dividend yield, 6.51. We like to see that, which is absolutely phenomenal. Have a look at this, 6.51 dividend yield. Their payout ratio is about 77%, so it's a lot, but still not big. And the dividend growth rate is in line or a little bit higher than the inflation. And they have been paying out dividends and growing the dividends for 56 years consecutive. Insane. So the good things about Altria Group as a dividend stock is they got a very strong dividend yield, which means if the 20% of your portfolio is in Altria Group on dividend stocks like this with a 6.51 dividend yield, and a recession happens or anything happens, then you will have some money that will be paid out to you. But because people are still gonna smoke if there's a recession, people are still going to buy the Altria products. They may have a little bit of decrease, but it's not a lot. And they got a pricing power despite declining volumes. So, less and less people are gonna smoke. But what do Altria do? They will increase the price. Why not? The profit margin stays the same. Less people smoke. The amount of people that still smoke, they will still buy it for a more expensive product. Absolutely good. The income doesn't change. Absolutely phenomenal. Defensive cash flow business. The tobacco demand for cigarettes and cigars and stuff like that, it's relatively stable. It's less sensitive to economic cycles, so they got predictable cash flows. So when recession happens, it's not gonna happen a lot. But if there's a boom in the economy and everybody's making a heck ton of money, then they aren't going to buy more cigarettes. So it's very stable. The bad things though, these are to consider. Declining smoke rates. Long-term circular decline in the cigarette usage remains the biggest structural risk for the business. Less and less people are gonna smoke. We don't see a lot of young people smoking today. They don't start to smoke when they are 13, 12 years old as they did in the 60s, 70s. So, and we've learned a lot about smoking since, and that is not healthy for you. So, regulatory and legal risk. It's heavily regulated sector. Tobacco is insanely regulated. And future legislations and lawsuits could potentially negatively affect the profitability. Maybe there will come a lot of big lawsuits as they had with the Juul company, I believe. Yeah, it is what it is. There's also limited growth upside. It's an income stock. They get a lot of money into their pockets each year, and they are spending a lot of it on dividends and share buybacks and reinvesting into the future of these non-tobacco products which people are gonna use. So it's not about a lot of growth, but it's about getting paid while you wait. So why is this ideal? The two growth stocks is risky, but it will either give you good returns or bad returns. And if they make bad returns, then we got the two stable stocks. They are the protection of the entire portfolio, right? So they are not going to drop a lot, but they are not going to increase a lot. It will stay quite stable. And then we got the dividend stock. It barely moves. It barely moves. I mean, Altria Group has moved a lot, but it barely moves. And they generate 6.51 dividend yield, which you can use to buy the dip when the dip happens. It's called diversification. It's very important, so you don't have all your eggs in one basket, right? So let me know in the comments, how do you diversify? I would like to know. But I got one extra stock for you, which is after this, the last couple of days I've looked into, okay? It's Celsius Holding. It's a fast-growing beverage company best known for its fitness-focused energy drinks. The brand positions itself as a healthy alternative to traditional energy drinks, emphasizing zero sugar, functional ingredients, and active lifestyle. Celsius has strong distribution expansion, especially through major retailers and partnerships, which has driven the rapid revenue growth in recent years. Celsius, right? Why look into this company? The share price is right now at $59.3. The market cap is at about $13 billion, which is alright. It's still not a lot, but it's alright. And we got the PE of 125. Earnings per share of only 39 cents. If we have a look at Celsius, the last year they are up $115. No, 115%, right? 1 year ago they were trading about $21, $22. I mean, the 52-week range is 21, so it's still an increase. But the 52-week high was at $67. And a lot has happened since. A lot has happened since like August, right? With the business model. And if we have a look at a stock like Monster, they are at a PE of about 40, but the market cap is at an $80 billion market cap. And they only got Monster. What is the nice thing about Celsius? They got Celsius, you know, the drink. In August they bought Rockstar from Pepsi, and they have a energy drink called Alani, which is primarily focused for the females and the younger generation. So the good things about Celsius is they got strong brand momentum. They have positioned themselves as a healthy energy drink, which is absolutely perfect with these trends at the moment with fitness and long-term health for young people. So the brand resonates perfectly with young consumers and young people like me. Then we got the partnerships. They are expanding through major retailers and partnerships. You're probably wondering, what is this partnerships? It's Pepsi, the Pepsi network. This boosts the visibility and the scale of the entire Celsius company. And the very nice thing is the Alani product, which is primarily for the females, or they're focused for the females. That has been integrated into the Pepsi network in, I believe it was December or January. I mean, the 1st of December, and then they also got Rockstar. So they got a lot of energy drinks, which, I mean, they got Celsius, which is it's good for health. They are saying healthy energy drink. They got Alani, which is for the females, and then they got Rockstar, which is just a normal energy drink, which was owned before by Pepsi, and now Pepsi instead. They sold it to Celsius, and then they bought, I mean, it's 12%, or they own about 12% of Celsius Holding at the moment. So they are backed by Pepsi, okay? And the third thing is the high growth profile. The revenue growth, if you look at the last quarterly reports, has been impressive. And that's also why they're trading at a PE of 125. It's absolutely impressive. And they are gaining so much market share with these energy drinks that it's unbelievable. The bad thing though is you have to look at the PE. You have to look at the valuation. Is this good enough? Is this too high for a company at a $13 billion market cap? It's trading a very premium valuation at the moment. And another thing is it's a very competitive market. We got names like Monster Energy, Red Bull, and then we got Celsius. But the other thing you could say is the growth expectations are also very high when they got Celsius, Alani, and Rockstar. So if they don't meet the expectations, then the share price will decline, and it can disappoint the market if the numbers are not good enough. It's a strong growth brand, but the execution of these growth and profitability, it has to be executed almost perfectly. So thank you guys so much for watching. Please leave a like and let me know in the comments, how do you diversify your portfolio? What percentage do you have in stable stocks, dividend stocks, or are you fully committed to dividend stocks, fully committed to growth stocks? Let me know in the comments. Thank you. Leave a like. Bye bye.